What is your reaction to the Fed's decisions announced today?
Well, it was very non-committal, and I think the market really anticipated that the idea that they're not going to make a decision or a prediction or any inclination about what's going to happen at the next meeting is completely consistent with the way the market and the treasury market has been priced. I did think, like Steve Leisman, it was a little bit of a hawkish kind of background tone to it. He sounds very resolute. He's certain that not stepping away at all from the 2% inflation commitment. He's right to say that inflation's come down a lot and it's not going to come down as quickly anymore. In fact, we believe at DoubleLink that the low inflation print is probably going to be this year around 4% on a year-over-year basis for the CPI. So that would imply that the Fed is going to keep rates around the level that they're at now unless something goes wrong with the economy, which is certainly not a low probability outcome. We've had these bank failures. This is what I talked about in the aftermath of SVB when we talked about how rising interest rates are something that people aren't used to. Not used to rising interest rates and then going up and then staying there for a protracted period of time. And it's going to have different ramifications than what most people's professional experience has taught them. And that's certainly the case with these bank failures. I mean, these people are pulling money out because there's absolutely no reason to keep their money in. You can get higher interest rates by a lot thanks to the Fed's 500 basis point interest rate increases. You can get bills at 5.2%. for a couple of months. And, the 2-year Treasury has fallen over 100 basis points in the aftermath of these bank failures. But it just seems to me that the deposits are going to keep drifting out. And I don't think that this is the last chapter in this regional banking problem. It harkens back to the S&L crisis way back when we had high interest rates and these S&Ls were losing their deposits. This is kind of the same phenomena, and I don't really see what's going to make it stop unless the Fed is going to cut interest rates, which there's no inclination of cutting interest rates in the next meeting. And the bond market says that there's not going to be any more rate hikes and that there's going to be cuts almost assuredly by the end of this year. And that's consistent with my view that we've talked about in past appearances, that recessionary odds are pretty darn high right now. The chairman was smart saying, we've got 500 basis points of interest rate increases. We've got credit contraction with the banking problem. We've got quantitative tightening. All these things have led me to having been relatively neutral to somewhat optimistic or tinged towards optimism on risk assets ever since really last September or so. I'm really turning more bearish at this point in time. I think the markets for risk assets are too complacent given this cocktail of higher interest rates, quantitative tightening, and credit contraction. Certainly, we should expect higher default rates in lower quality fixed income securities as we move into the end of this year. And I'm strongly of the opinion that investors should be going up in quality in bond portfolios. And we might finally crack down below 337 on the 10-year, which has been this amazing barrier that we can't get through. We tried to get through it today. We couldn't get through it. If there's a recession, we'll probably get through it. And I'm toying with the idea that this might be the last flight to quality rally that really creates profits for Treasury bonds, because I'm really worried about the deficit situation in the United States. We're not even in a recession yet, although the economy is only growing at 1.1 in the first quarter. But we have a 7% deficit as a percentage of GDP, and we're not even in a recession yet.
Do you believe that today was a mistake and that the Fed should have not said anything at all?
I think they should have done nothing today. But I've heard a lot of commentators say these words that I agree with. 25 basis points isn't going to make a huge difference. It's certainly there's always the straw that breaks the camel's back, but 475 or 500 basis points over the course of a little over a year, it's kind of the same thing. So I just harken back to what we talked about when the Fed started raising interest rates. They started too slowly. They should have raised interest rates a lot more in the middle of last year, and they waited until really those multiple 75 basis points. And that was because the bond market was throwing a fit. And we probably would have had this regional banking problem to this magnitude if the Fed had started raising rates more dramatically early on. Like I talked about, a 200 basis point move should have been their first move. We probably wouldn't have gotten the long bond to a 50% drawdown that hurt, obviously, SVB and other banks. And certainly there's lots of underwater securities that remain in the banking portfolios. So I think today was on the margin. I guess I'd call it a mistake, but I think the market was completely prepared for this exact press conference, this exact statement from the Fed. It's extremely non-committal, but I would bet pretty strongly that the Fed's not going to raise interest rates.
The Federal Reserve is responsible for setting monetary policy in the US, which includes determining interest rates. At its recent meeting, the Federal Reserve announced that it would not be changing interest rates, which was in line with what many market participants had been expecting. Jeffrey is showing a negative outlook on the market. He thinks that prices of riskier assets such as stocks may be too high given the potential risks of higher interest rates and credit contraction. Credit contraction is a decrease in the availability of credit or loans, which can also negatively impact economic growth. Treasury bonds are considered safe as they are backed by the US government. A flight to quality happens when investors move from risky to safe assets like treasuries. Jeffrey is advising adding treasuries to portfolios due to a favorable environment.